I then have the privilege of introducing Mr. DJ Van Keuren, who will provide some very interesting oversights and observations on a national basis on his view of family real estate and really where he's seen some of the research come in and some changes over the past year. I'll introduce our guest speaker for this evening, DJ Van Keuren. DJ is a fascinating man. We're a big fan, very supportive of the work he's doing. Some of you may be already familiar with his research and contributed to the annual survey during this past year. He himself has had investment responsibility for multiple large family offices, real estate side. He's designated as a top 10 family office real estate professional, a top 50 opportunity zone expert, a top 30 family office real estate investor. And he has it all nicely rounded out of the master's degree in management and finance from Harvard. And like I said, we've been a real fan of his work, a real supporter of his work. And I think it'll be interesting tonight to hear from him and what he can share with us.
Well, first and foremost, I know that we were going over the other day when we were walking through this stuff. You guys are spot on with everything that you guys are saying. I mean, it truly excites me when it just confirms everything that I look at too. And first and foremost, want to thank you for allowing me to be here. As I've mentioned before, not to the people online, but my wife and I consider Seattle home, and specifically Elki. And we're trying to get back there. We made it as far as Denver. But what's interesting is that when we moved here about 7 years ago, it reminded me of Seattle in the late 90s. And you get a lot of growth that's happening, and you are very fortunate to be in a great opportunity. A couple of years back, I've been working for a number of families over the last 6 years, and that has included, if you remember, the Heyman family with George Perfume, George, also a family member that owns with the family that owns the Colorado Rockies, and currently doing some work with the Marriott family where we're buying some distressed hospitality, and then also Jim Sorensen, who's a global impact leader actually. And over these 6 years, I realized that there was really nothing out there that would allow for families to see what other families are doing. So we did our first report back in 2019 for Family Office and how they invest in the real estate. And then we did our last one last year, which is for 2020. And we're going to start gathering some details and information going into this upcoming year. So let's go ahead and start diving into. So when you look back at 2018 and 2019, the average portfolio return was about 14%. And when you look into going into 2020, that was the targeted return that you would that families were expecting to have as well. My understanding at Trinity that's been right in that ballpark of where exactly they've been, and so that just confirms what families are doing on a national basis. When we look at what family offices are interested in investing into, what you'll notice here is that multifamily has been the choice for families to invest into in 2019. And when you go forward and you look at 2020, it's the exact same thing. It's pretty close. Multifamily is the property type of choice. And here going into 2020 as well, industrial was a second area of interest. And as was discussed earlier, industrial has really been one of those areas that have done really well this year. It's really driven down a lot of the cap rates because of the demand. And of course, that's been really pushed by companies, local companies like Amazon, that's been expanding into various areas, and everybody been ordering from home. Now, one of the things that's going to be very interesting from Amazon's perspective is we had so many retail locations that actually went out of business over this last year, filed for Chapter 11. And so let's say JCPenney's an example, Sears is another one. And so will they be taking these big boxes and actually creating warehouse space so that they can increase that delivery time for Amazon. They already do a tremendous job right now getting it to areas and even the same day, but that's also going to be an area that I think they're looking at in order to expand, and they've been moving in that direction already. Now, how family offices expect to invest in real estate in 2020? This has been a consistent trend actually over the last 5 years, and it's been direct investing. And there's been a number of reasons for that. And I believe that you all at Trinity actually have a lot of direct investing, and it's because you can actually see families like to know what exactly they're buying, right? Whereas in a fund, you're going to have a whole, you do have diversification, which is great, but also you can't really get keen insight to what's happening to those actual properties. And so direct investing is continuing to drive where families want to invest. It's actually also happening on the private equity side, but it's a great place to be, especially if you're owning it yourself. Also, there's a lot of co-investments that's starting to happen and continuing to happen with families, and that's investing together into various properties. Now, when we look at the allocation of real estate in 2019, you can see that there was a small portion that was actually decreasing, and you had quite a bit of people that were staying the same at 45%, and there was an increase about 43%. Now, going into 2020, the decrease wasn't happening. It was actually increasing. All of that was decreasing actually increased into 2020. The reason for this is because families were really getting great returns on their properties and real estate. And as the wave was continuing to climb, they wanted to have a greater exposure into that area. Now, that was what was happening pre-COVID. And we're going to talk a little bit about what's happening in post-COVID with families since that's happened, let's say, starting in about February. Now, one of the things I forgot to say at the beginning, and I open this up to the people here at Trinity as well as anybody that's listening in. If you have a question as we go through, please ask it, send over a message. Bridget, let me know, because that way we can maybe address some of the questions you might have as we're going forward. So where were the strategies and the top strategies going into 2020? Well, if you notice that opportunistic was the majority at 76%, followed by value add, and then distressed. And one of the questions that came up, I'm going to answer now, that came up earlier, and the question was, okay, with so many people investing into opportunistic, was that going to cause a problem for future generational growth, legacy growth? The answer to that is no. The reason why people were investing in a lot of families into the opportunistic and value add, and now even more so in distressed, was a couple-fold. One is because many want to get higher rates return. So you've got two classes of investors, where those that want to get the higher returns, which you get through the opportunistic, the value add, the development, and then you have others that just say, hey, we want a core of having a return, having cash flow that's continuing to come in. And so a lot of families, and I would say the majority, felt that, okay, we should be able to see, we're going to have a downturn coming, because things have been just going so well since we hit the last recession, and things are continuing to move. Well, that is why a lot of the money was moving toward the opportunistic, to say, well, let's try to get in and out before we start really seeing somewhat of a downturn happening. But the best way to invest with a lot of families is that you go into an opportunistic development value add deal, you end up stabilizing that property, you refinance out, and then you hold on to it for the long term. Anytime that you're investing in the real estate, and we'll talk about this here, it's such a tremendous asset class. Obviously, I'm a little biased because I'm just so passionate about it, but with all the tax benefits, all from depreciation, amortization, writing off interest rates, by all means, even if you go into an opportunistic, it is not going to cause an issue in creating that generational wealth, that legacy wealth. And so, to answer your question, by no means, it's not going to cause a problem. And that's one of the true benefits of actual family office, that long-term patient capital and truly having that there for future generations. Now, the other thing too, I am going to, even though a lot of families were worried about that we were really seeing a long growth that was happening, being worried about the next downturn and recession happening, you can actually go back 250 years in not only the US, but also Australia and the UK. And on average, real estate will go in 18.5-year cycles. And so based upon that, pre-pandemic, that meant that we should have seen a downturn coming around 27 or 28. And of course, the pandemic has sort of pulled back the reins. But one of the things to notice on that, which I really want to bring up, is that places like a Seattle, places like a Denver, a Salt Lake City, the fundamentals are still there. You've got cost of living, quality of life, you got jobs. Obviously, Seattle continues to keep growing. It's showed up on the map. Back when I was there in the 90s, we would tell people moving in from California that it rained all the time because we were trying not to get the people to move there. But obviously that's been out, and it's continuing to drive and will continue to drive growth, especially in Seattle and some of the other areas that I mentioned. Will we see a downturn coming in 27 or 28? I think you could probably push that back a couple years because the pandemic has pushed that time frame a little bit. But once with finding out that we've actually got a vaccine that's coming, a lot of people think things will start getting back next summer. Once again, things are just going to start taking off once again because of the fundamentals hasn't changed. And in many regards, I think that's going to improve and increase even more so. I know a lot of people from California and some other areas having to deal with the financial hardships are actually moving to areas like where I'm at because of a lower cost of living. So when we look at how long families want to hold, you can see back in 2019 that you had the majority that wanted to hold 15 plus years. It goes back to what I had mentioned before about having a value add opportunistic development deal, having a stabilized refinancing now, and holding for the long term. Well, if you notice, when we go into 2020, we went from an 18% for 5 to 7 year up to a 29% 5 to 7 year hold. Once again, that goes back to something I said before, which is you had a lot of families that were worried that the downturn was going to be coming. So let's try to get in and get out from that perspective. Social impact is something I want to talk about really briefly here. And, social impact, ESG continues to come up with families over and over again. But when you look at real estate, considering it, we had quite a number that were saying, yeah, we're considering it, over 50%. However, then when you look at who has actually done this is in the 59% range. So that means that, yeah, I've thought about it, but I really haven't done it. What's driving this and what's going to drive social impact on a go-forward basis is going to be the younger generations. And for those that have kids and multiple generations, you're probably seeing this. Today, if there's an opportunity to get an 18% return, but you don't have a social impact, what I've seen is that the patriarchs are saying, okay, well, let's go for the 18, right? Instead of a social impact where maybe we're getting a 14%, but we're doing a lot of good. The younger generations are what's driving the social impact. So in the future, they're more apt to say, hey, we'll take a 4% that is going to help society and the world as a whole, rather than that 18%. And as you know, that 4% can make a considerable difference. So we expect these numbers as the next generation starts taking over to actually increase for how much is going towards social impact. 1031 exchanges. I understand that you guys do 1031 exchanges. We're talking to Richard and Bridget about that. That there are being done by clients. This is one of the best tax benefits that are out there, especially when you're looking at long-term generational growth, legacy growth. If you have the ability to go from one property and do a 1031 exchange into another property, you definitely should take advantage of that. And in fact, that's where a lot of the wealth has been created. The first patriarch that I worked for, he turned $1 million into about 700 million today. That's unlevered. And, you know, we were talking one day about the benefit of compounding growth. And I was showing him a graph that I put together, and he was like, wow, that looks exactly like something I did. You know, his strategy was value add, opportunistic development deals, and then he'd go into another deal, and he has about 250,000 or 250 million, I'm sorry, in 1031 exchange money, which just continues to compound. Unfortunately, what you can see here in 2018 is that 68% of families weren't taking advantage of 1031 exchanges, and in 2019, 72%. Actually, I'm sorry, this was 2019 and 2020. I apologize for that. So last year was at 68, this year at 72%. Hopefully that will increase, but it's usually more high net worth that are doing 1031 exchanges, whereas families really need to take advantage of that. And for those that have, you know, congratulations to you guys, because it does make a considerable difference. So what is a motivation for families to invest beyond return? The number one area is the ability to generate generational growth, create generational growth. And I can't tell you over and over again how important real estate is, and I'll talk about this here in a little bit more, how real estate is one asset classes in order to do that. So the ability to generate generational wealth is a big number. Opportunities to invest directly, which we talked about before, with the majority of families wanting to go direct anyway. And then it also creates diversification and once again, tax benefits is another main benefit that real estate can really help you with, and is what families are doing. When we look at performance and expectations. So COVID has definitely had an impact on real estate investing by family offices. And what was happening that we were seeing, not only with the families that I was working for, but also other families, is that the first thing is that the majority of all families went straight to their equities portfolio. They were looking to take money off the table from what they've had increases in, and then they were looking to put that money back into the market. Because of that, they were pulling back on real estate and actually waiting to see how those properties were doing. I think it's been a great time to really look at your portfolio to see how they're performing and how they're acting during this little bit of time downturn. But what's also interesting is that a lot of families weren't taking advantage of the recession last time, and they were waiting to see what was going to happen. And so the majority was hopping in. Once that trend was starting to go back up, a lot of families started hopping back in. And so they actually missed out on a lot of the growth that was happening. This time, that memory is still there, fresh in their minds, and they're ready to take advantage of any distress that happens in the market. And Pete mentioned it earlier, is that distress is an area that's been of interest. And the first area that's really been happening is in the hospitality sector. You know, we've seen the big downturn that's happened. You look at a lot of the luxury hotels, whether it's Four Seasons or whatnot, they've been occupancy of 7 to 9%. Where there's really been a great opportunity is in that select service. You're looking at the Courtyard by Marriott, the Fairfield Inn, the AC by Marriott. And what we've seen in the market, because we've been doing some work with the Marriott family directly and Mr. Marriott himself, and we have been seeing a 20-30% discount. And so there are opportunities to pick up some of the hospitality, and you have a lot of owners that might have 8 to 10 locations, whatever flag that they had, and they've been saying, look, you take any 2 that you want to, because they want to make sure that they keep the 10, you know, and being able to get through this time period. However, just like assisted living, you have to make sure that you've got a great partner, because hospitality, yes, it's real estate, but it's really a operational business. But that's the first place people were looking. Retail, this was brought up again by those at Trinity. There's definitely been an opportunity. What we found too, which I'll talk about here in a second, is really what retail was able to benefit and to stay the course through this pandemic. Retail's definitely been hit in a lot of areas. If we go into next year and we've got some mandates that come in from the new president, that may hurt the retail as well. And then also you talked about a lot of the malls and what's happening with the malls. I mean, Bellevue Square is going to stay, and it's always going to be one of the main locations that people are going to, but some of the other malls may not really stand the test of time to get through this. Debt is another area that families are looking at to take advantage of and distress test debt. We're already starting to see some of this coming out, and the CMBS loans are going to be an area too that we're going to see some decreases happening and opportunities. Multifamily housing. Multifamily housing, once again, families, this is the area that families love to invest into. You know, you look at a place like Seattle, and there's just tremendous opportunity for that. That's going to continue to grow, especially as the housing prices continue to increase. And but there's different categories. So you've got the Class A, which is really white collar workers. You've got the next level, which is in the B range. And then you've got workforce housing. And workforce housing has been known as recession proof. However, one of the areas that you do want to be careful of is that we've really had a lot of money coming in with stimulus. And that's primarily been going into that workforce housing blue collar area. These are the people that work the retail that may not have a job to go back to, or retail hasn't been available. And so once the funding comes from the government and it stops, there could very well be a problem with some of this workforce housing, which is going to create an opportunity and a buying opportunity. Usually multifamily lags by 6 to 9 months, and that's time frame when people stop paying to when that they start the eviction process. So it lags behind. So multifamily continues to go along in the Class A. It's a great place to be. It gives you diversification within all the people that are having number of tenants. However, there could be an opportunity coming up in workforce housing. Industrial, we talked about that a little bit before. It's been doing extremely well. It's been driving cap rates down. Where there's been, prices that are more expensive. From my personal perspective, I think a lot of the industrial, you're going to be paying premium prices. I think where the industrial side is perhaps a great industrial product that people have been looking at are the Amazon warehouses. Some place that you can get a great quality tenant that they're already signing the lease before it's even built is a great place to pick up industrial. Down south, a lot of industrial that has been going on over the years and continued, but it is a great property type. Once again, it comes back to the tenant. Essential retail. Essential retail is a word that I think we're going to start hearing more and more. I sort of came up with essential retail. I thought I did actually until I heard other people using that same word. And when you look at what was considered recession proof, you'd have a certain type of property type. You'd have the self-storage, you'd have the senior apartments. And what we found out is that there's certain retail that will hold up in any type of market whatsoever. Those are the CVS's, the Walgreens of the world, right? The dialysis centers, 7-Eleven, and some of the big convenience stores have done extremely well. In fact, we're the second largest owner with the Monfort family and of 7-Elevens. And when gas prices went down, we actually increased the margins from gas, and we've continued to see a lot of consistency that's happened. So it's those property types that will continue to go on regardless of if we go into a recession or if we do have a pandemic, because unfortunately I think we might see something like this happening in the future. It's something to be aware of. Opportunity zones. I got a question the other day by an opportunity zone from a family, and they said, hey, what do you think about this? It's in Seattle, and it was in the International District. I have to tell you, I went on Google, I started driving the street, and I almost fell off my rocker because I could not believe what's been happening down there. And it really shouldn't be an opportunity zones, but they definitely provide some great ways from a tax efficiency perspective However, I think what's going to happen, we saw an increase in opportunity zones from family, very little from last year to this year. A lot of it was because the regulations weren't out yet. Families really didn't understand either about how it works or, where is the dust going to settle. Now, there's been a lot of gains, I think, that's been taken off the, from the stock portfolios. I think we're going to continue to see an increase going into next year into opportunity zones. Once again, and I'm sure they've told you, when you're taking a look at it, you still want to look at what's the risk reward. There's definitely a tax benefit from it. Does it justify? The great thing is about it is that if you do look at that, you should be able to get some good cash on cash returns going into year 4 or 5 and going into 10-year plus. It is tax free. Once again, going back to the importance of legacy assets and wealth creation. 1031 exchanges, there was concern about that being erased for families, for any people that made more than $400,000 a year. It's looking like hopefully the Senate will be able to control that, which means that probably is not going to be taken off the table. And there's actually a tremendous amount of reports. Happy to share with you guys, if anybody wants any, about the true benefits for economic benefits for the country and the areas that 1031s actually provide. So we're not so worried about that happening anymore. So when we said that the family's reality, Vanderbilts have been one of the best families, the largest family, everybody knows about it, but they subsequently saw the family's fourth generation actually dwindle away by the third gen. And in fact, statistically, 70% of the wealth by a family is typically lost by the second generation, and actually 90% is lost by the third generation, which is crazy. And there's a lot of reasons for that, why that happens, but that's a significant amount of wealth that's been created that is gone. So the solution, quite honestly, real estate. And you have to be aware that, from what I've learned in the research I've done about how families view an advisor in the real estate sector, it's an area that's growing more and more. And I have to tell you is that other than myself, when I came across everybody at Trinity, I can't tell you how excited I was, because it's somebody else that has that belief of families and real estate. And you just don't find that out. You guys are very, very fortunate to have that. I have to tell you, the quality of people and organization that is with Trinity, and I sincerely mean that. And some of the benefits is that when you do have an advisor, specifically in the real estate sector, they've got boots on the ground. They're able to go and check out the property, right? One of the issues that a lot of people have is that, okay, great, I own the property, but it's a pain in the butt because I got to make sure I'm getting calls in the middle of the night, or there's issues to deal with. When you've got somebody you're working with, you've got boots on the ground. It's also an extension of your internal team. If you've got other people that are looking into other areas, whether it's private equity or venture capital, or even looking over your equities portfolio, this is a specific area that it provides you to have somebody, focus on this real estate. Increasing your reach and knowledge. Education is a huge component. Super excited when I hear about what they're doing over at Trinity with that education, and I've taken that same step over the years to provide that. And actually how that report came about was to say, let's see what information that we can provide others. You also hedge your bet. Real estate, it will offset some of your other investors when investments, when they're doing very well. Your real estate might be a little less from a performance center perspective, and vice versa. So real estate can really help. And also, you have to understand, look, when people go to their attorneys, they go to wealth advisors, they go to their accountants, they do that because they want their advice, their professional advice to help. And there's nobody better than having an advisor in the real estate sector that really understands not only what's happening in the various properties, happening in the area, and the benefits that can truly be brought by having an advisor. And the reason why this is so important, and I'm going to finish on this right here, is that whether you created your wealth in technology, or wealth was created in chemicals, or wealth was created in tires, whatever that case is, wherever that wealth was generated, and for many families, it's actually where they created their wealth. But real estate is the largest area of wealth and legacy creation after the industry that the wealth was created for the family. And I can't emphasize that enough. I can't tell you how many families have actually increased their net worth significantly by really taking advantage of what real estate can provide. And once again, going back to a couple slides before, is that one of the ways that you can actually make sure that that wealth gets beyond that second generation, that third generation, and into the fourth and fifth is real estate. And it creates income. It creates a great foundation.
Hey, DJ, this is Bridget
Yes.
Roberts from Trinity. And I just want to say on behalf of all my partners, we really appreciate you being part of this event, and also to say thank you very much for your informative and very meaningful content. We are now transitioning to the Q&A
Well,
session.
I hope that.
Yeah, go on.
Yeah. No, I was going to say, I hope that the connection was okay. So.
Yes, it was terrific.
Okay.
I do have a question for you that came in from one of our clients. You touched base on the 1031 exchange.
Yep.
They want your opinion. The capital gain tax, there is the possibility capital gain tax will change. When you compare that and the benefits of the 1031, would you still do a 1031?
I guess let me rephrase that. They're saying if the capital gains increases, is it still beneficial to have a 1031 exchange? Was that the?
Yeah, they want it. It would be important for you to explain how you would defer taxes by doing the 1031.
Yeah. So if capital gains go up, you're actually going to you should be more inclined to use a 1031 exchange. So what happens is that for those that aren't aware, but once you sell a property, if you've got $1 million in capital gains, you've got two choices. You can pay Uncle Sam that money, or you reinvest that into another property. By doing that, instead of paying whatever that capital gains rate is, if it goes up to 40%, that could be $400,000, right? If it's a $10 million gain, that's $4 million. So you've got two choices. You can give it to Uncle Sam, or you can take that $4 million and reinvest that into another property, deferring that gain for the future. So now you're going to have so much more purchasing power, because you have to figure is that 10 million should go to 20 million, and then 20 to 40 million. And there's just so much tax that you're able to defer. And based upon the guidelines today, when you die, you get a step-up basis to your next generation. And so there's no taxes on it.
Yep.
That's just a whole nother reason why it's been fantastic. And if you're not taking advantage of it, 1000% you need to do that.